If you have ever wanted to learn about investing in the stock market or have tried and not had any success, then in this video I'll explain the 2 reasons why it's so important you learn to invest. By the way, I'm speaking from experience. My name is Justin. I'm a full-time investor. I run an investment club, and I'm also about to have a book published later on this year about investing by Harriman House. I turned £1,000 into £93,000 by investing in the stock market. In fact, those figures aren't entirely accurate, but the multiple is. Later on in this video I'll show you exactly how much I started with and how much I ended up with by investing in the stock market. Okay, 2 reasons why it's so important you learn to invest. Number 1, inflation. Number 2, wealth creation. Firstly, inflation. Inflation measures how much more expensive a set of goods or services have become over a certain period of time, usually a year. The Bank of England's inflation target is 2%, but in October 2022, this inflation rocketed to 11.1%, and as I record this right now, inflation, the last reading on inflation, was 2.3%. You're probably thinking, okay, 2.3%, not too bad. But this 2.3% figure is on top of last year's inflation figure, and that's on top of the year before, which included that 11.1%. So prices continue to rise. This means if your wages are not growing faster than inflation, you will not be able to afford as much as you used to. In other words, the value of your money you earn is decreasing. The average inflation rate in the UK from 1980 to 2020 was 3.75% per year. This means that something that cost £1 in 1980 would now cost £4.14 in 2020. That's a rise of 314%. If inflation continues at this rate, in 2060, this is how much these items will cost. A loaf of bread, right now, around about £1.58. In 2060, £6.57. A latte coffee, now, in 2020, around about that day, £3.51. In 2060, £14.60. A pair of Adidas Samba trainers, 90 quid right now. In 2060, £374. Filling your car with petrol, let's say it costs £100 right now, it'll cost £414. And a 46-inch LED TV, around about 250 quid right now, it'll cost you £1,035 in 2060. So, just doing nothing with your money means it will be worth less. But investing is one of the most effective ways to grow your money, to not only beat inflation, but to create wealth for yourself. Which brings us on to the next point. Wealth creation. If you are employed or self-employed, there's a limit, a cap to how much money you can realistically make. If you are employed, you trade your time for money. It's highly unlikely that your boss is going to say, I'm going to double or triple your salary or give you a 10% pay increase every year forever. Even if you are self-employed, there's only a certain amount of hours a day you can work, a certain amount of customers you can service or clients you can service on a daily, weekly, monthly basis. So, if you work for money and there's a limit to how much you can earn, there's only one effective way to increase this money. Make the money work for you. You can do this by investing. Depending on what you invest into, you could turbocharge your earnings many times over. If you invested £100 a month in an S&P 500 tracker, which is a fund that invests in 500 of the biggest companies in the US, it has historically returned around about 10% a year. This means on an annual basis, if you invested £1,200, you'd get a return of £120 from that 1,200 quid. If you then reinvested this, it would compound your returns, meaning next year you would not only earn money on the new money you invest, but on the money you earned last year. This is a powerful long-term force. If you invested £120 a month over 40 years and achieved a 10% return a year on it, you would have amassed £584,222. Now, an S&P 500 tracker is not a particularly high-risk investment, as it invests in the biggest and some of the most successful mature companies in the world. A higher risk-reward strategy is to pick individual, smaller companies that have the ability to grow faster. If you become good at picking these types of companies, you can do a lot better than 10% return a year. Since November 2009 to now, my total return has been 4,620%, and this is after the bear market. During the peak of the bull market, I achieved a return of 9,036%. I started with £30,115 in my ISA in 2009, and on the 1st of May 2021, that value hit a peak of 2,751,467. Now, I'm not going to sit here and pretend it's easy to make money in the stock market or become a good investor. It's not. Like any skill, it takes time and practice, but it's a skill so worth learning. There's no better investment in yourself. In fact, I believe it's so essential a skill that it should be taught in schools. If you become a good investor, you can make money for yourself. You can even become completely financially independent. It's one of the most effective ways of creating your own wealth. Thing is, there's thousands and thousands of options when it comes to investing. What makes the best investments? That depends on your age, your experience, and risk appetite. However, in my book, I discuss in detail my what, when, how strategy. This outlines the individual companies most likely to give you the best return on your money for a relatively low risk. I also explain the best time to invest and when not to invest. I also discuss the how of portfolio management, a skill that is essential when it comes to making money and, more importantly, not losing it. This is because most private investors lose money on the stock market largely because they pick the wrong companies which are too high risk and have no portfolio management strategy. By the way, most private investors lose money because of two common mistakes. Number one, they hold on to their losers too long. Number two, they sell their winners too early. The reason most private investors hold on to their losers too long is because they only focus on the reward. As investors, we are hardwired to think of the money we will make, but investing is about risk management. You risk your money to achieve a reward, but investors focus on the reward before they focus on the risk. If you only focus on the reward, you'll probably invest too much money in a very high risk reward company because you think, if I invest £100 and this doubles, I'll get £200. Hang on, if I invest £1,000, I'll get £2,000 if it doubles. The trouble is, most private investors have no plan if the investment goes wrong because they're only thinking about the reward, not the risk. This is what's called an emotional investment and becomes more emotional the further the share price drops, which invariably leads to irrational decisions. Your investments should be based on financial and technical metrics, not emotions. Believe it or not, the quality that separates poor investors from great ones is discipline. This is why you need a robust strategy you can believe in, which will remove emotional investment decisions. My book explains my strategy and my investment club helps you learn it. On my website, I've also recorded videos to teach you how to read income statements, balance sheets, cash flow statements, plus a video on how to set up charts to observe trends, downtrends, and ranges. I can also teach you to set up alerts that tell you when a company is most likely beginning an uptrend. With my investment club, I also go over these lessons on a live weekly webinar. Plus, we look at many potential investment ideas every week and assess them on 20 different metrics. These companies are then scored, color-coded according to these metrics, and ranked in the MICROCAP League. Now, if you are genuinely interested in learning to invest or become a better investor, then visit sharepickers.com/subscribe. There's a free cheat sheet there, okay? It's a quick summary of my book and investment strategy. If you download this cheat sheet in the next 7 days, you will also qualify for 20% off membership to my investment club. If you want to know what my current members think of my club or my investment book, here's some testimonials. If you have any questions, please submit them in the comments below. Thank you for watching.